Because the Strait of Hormuz remains effectively shut, energy companies are collecting windfall profits while the rest of the ASX absorbs the shock, and the difference between those two worlds is now the defining feature of Australian markets. Israel and the United States struck Iran on 28 February, choking off roughly 20% of global oil and gas supplies. Brent crude has risen 42% in 30 days to just above US 103. European gas prices are up 64%, UK gas up 69%. The knock-on into thermal coal, up 15%, reflects power plants switching fuel sources as gas supplies tighten. The ASX 200 has shed about 7% since the start of March, but the energy sub-index has gained 16% over that same window. This is not a market moving together, it is a market being cleaved in two by a single supply shock. The cleaving mechanism is now feeding directly into dividend flows, which creates a second-order dynamic worth watching closely. This week alone, $12.5 billion in dividends hit investor accounts, $5.2 billion from BHP on Thursday, with Woodside Energy and Telstra paying out Friday. Next week adds another $10.7 billion from Commonwealth Bank, Fortescue, and Wesfarmers. The two-week total of roughly $23 billion represents about 70% of all dividends declared during the February reporting season. Institutional investors, according to Bell Potter's Richard Coppelson, are likely to redeploy this capital quickly into beaten-down stocks. That creates a potential self-reinforcing rebound. The same war that depressed equity prices also elevated energy earnings, and those elevated earnings are now funding the cash that may lift prices. Solaris portfolio manager Charles Casey flagged Woodside, up 20% since the conflict began, and fuel supplier Ampol, up 18%, as direct beneficiaries, noting that Qatari gas competitors have seen production disrupted for potentially 3 to 5 years, leaving Woodside supplying into a structurally undersupplied market. If tensions begin to ease and oil retreats, that dividend reinvestment tailwind would coincide with a de-escalation rally, compressing the recovery timeline. If the conflict extends, energy earnings stay elevated but the broader market damage deepens. The same geopolitical uncertainty that drives energy gains is also producing violent daily swings in defense stocks, but the mechanism there is sentiment rather than earnings. DroneShield fell 14% earlier this week when ceasefire rumors circulated, then recovered nearly all of that decline, up 19.4% on Wednesday, after Iran rejected the U.S. ceasefire proposal and called it unreasonable. The stock is up 330% over 12 months and 28% year-to-date. AML3D, a smaller additive manufacturing defense play, jumped 20% on a separate catalyst, a US $1.84 million contract with the US Navy's submarine industrial base, using 3D metal printing to replace components no longer available from original manufacturers. The contrast between these two stocks captures the structure of the defense trade, one stock priced on geopolitical sentiment, the other finding a more durable foothold inside US defense procurement. Analysts have a 12-month target of $450 on DroneShield, implying modest upside from current levels, which suggests the easy money from the sentiment trade may already be largely priced.
Gold's behavior through this crisis has been counterintuitive and reveals a mechanism that trips up many investors in fast-moving conflicts. Gold hit a new all-time high of $5,600 per ounce on 1 March, then collapsed to $4,300 within weeks, even as geopolitical risks surged. The mechanism: at the onset of a black swan event, institutional investors reach for US dollars rather than gold, because dollars are more liquid and can be deployed faster in volatile conditions. Silver saw the same pattern, falling under $66 from a January high above $120. This is consistent with how gold behaved in the early weeks of both the 2020 COVID shock and the 2008 financial crisis, an initial drop followed by a sustained rally once the fog cleared. The argument for a rebound to 5,600 or beyond rests on the same historical pattern. As investors digest the duration of the energy disruption and its inflation implications, zero-yielding assets like gold tend to recover. The risk to that thesis is that central banks respond to the energy-driven inflation spike with rate hikes, which historically compress gold's appeal by raising the opportunity cost of holding it. While energy and defense dominate the headlines, a quieter but significant divergence is opening inside ASX technology and healthcare. Medicus peaked at $336 last July and now trades around $118, down nearly 65% from that high, despite reporting 28% revenue growth and a 30% profit increase in its February half-year results. Brokers including Morgans and Bell Potter argue the sell-down is sentiment-driven and disconnected from fundamentals. At the other end of the spectrum, Catapult Sports surged 11% on a trading update showing 27-28% annualized contract value growth and a projected 50% rise in management EBITDA, proof that software businesses insulated from energy and supply chain exposure can still deliver in this environment. Starpharma, a biotech using dendrimer drug delivery technology, has risen 365% over 12 months, after landing licensing deals with Genentech and Radiopharm. The divergence within tech and healthcare mirrors the broader market split. Businesses with direct exposure to the physical economy are being repriced by the energy shock, while software and biotech are being repriced by sentiment and rate expectations. 3 conditions will determine which direction each of these chains resolves. First, the pace of ceasefire progress. If Iran and the US reach a deal within weeks, Brent crude retreats, energy earnings guidance gets cut, and the $23 billion dividend reinvestment rally may be the only near-term lift for the broader market. Second, the inflation read. If energy-driven CPI stays elevated into May, the Reserve Bank of Australia faces pressure to delay any rate cut, which would extend the compression on long-duration assets like Medicus and Xero. Third, whether the gold recovery follows the COVID or GFC playbook. A sustained move back toward 5,600 would confirm that institutional investors have shifted from dollar safety to inflation hedging, which typically marks a broader turning point in risk appetite. Each of these is a binary with a clear mechanism attached, and that is what makes the current environment both difficult and legible. The causal chains are visible, even if the timing is not.